It seems that the worst is in for the housing market with the biggest decline since 2011. There is certainly a mixed feeling out there with the doom of losing faith in financial markets as we see the backbone of our economy, real estate, fall out the bottom while people celebrate lower prices but struggle to sign the mortgage papers with higher interest rates. There's a lot in there. Home prices have declined 0.77% from June to July, the first monthly decline in nearly 3 years. It is also the second worst July performance dating back to 1991, behind the 0.9% decline in July 2010 during the Great Recession. Now, Goldman and Sachs expects that home prices will fall in 39% of the US cities next year, and economists now expect this slowdown to result in lower prices in nearly half of markets across the country next year. Now, Goldman expects Western markets like Denver, Phoenix, and Los Angeles to experience some of the sharpest declines in home prices next year. East Coast markets like New York, Philly, and Boston should all see home prices continue to actually appreciate. So how can you make money in this decline? And so to find out, make sure you go out and smash the like button, subscribe, and ring that notification bell if you think this type of content would help you make better decisions for your future. Right now, one of the major contributing factors is reduction in mortgage refinances. Mortgage refinance is basically replacing your old mortgage with a new one. Now, typically people do this for the following reasons: to obtain lower interest rates or to take out profits and reinvest in subsequent projects or properties down the track. And of course, if the interest rates are high or if the prices are too high already, people aren't really going to do this. And on that note, refinance demand fell another 4% for the week and was 83% lower than the same week 1 year ago. With rates above 6%, only about 452,000 borrowers could benefit from a refinance. Mortgage demand appears to have nowhere to go but down as interest rates go up. Application volume dropped 1.2% last week compared with the previous week. Now, mortgage rates, which had been easing slightly through July and August, pushed higher yet again after Fed made it clear to investors that the central bank would stay tough on inflation, even if it caused consumers a lot of pain. Also, national inventory levels are up for the 5th month in a row, the 3rd month with a record increase as falling demand continues to cause inventories to build. Las Vegas, San Jose, Seattle, and San Francisco have all seen inventory return to pre-pandemic average, with Las Vegas actually running a 28% surplus. And if sales continue to fall at the rate seen over the past 4 months and inventories continue to build at current rates, we would actually cross the 6-month threshold by December, tipping the market in favor of buyers for the first time in recent years. However, the inventory may not continue to grow to bring such a drastic fall in the housing prices, because vast majority of homeowners have positive equity, meaning they owe less on the property than ever before. Take a look at this, guys. A national home price decline of 5% would result in just 0.9% of homes becoming underwater, most acutely impacting borrowers who purchased their homes in 2022. Okay, let's have a look at a 10% decline. That would push the negative equity rate to 1.9%, marginally above 2018 to 2020 levels, with 2022 purchases accounting for 70% and 2021 home buyers representing another 21%. A 15% blanket decline in price would result in a 3.7 negative equity rate, with 2021 to 2022 purchases again accounting for more than 90% of the borrowers falling underwater. So as you can see, the biggest danger lies with people who bought property at high leverage in the recent years, and it comes to show how important it is, especially for you, to invest in things like property with a long-term focus. Now, Goldman Sachs projects sharp declines this year in new home sales, 22% decline, existing home sales 17% drop, and housing GDP 8.9% drop. It projects further declines in 2023, including another 9.2% decline in housing GDP next year. Goldman Sachs Global Investment Research wrote that they expect 39% of metropolitan areas to experience price declines. Now, note that this doesn't actually mean the prices are going to fall by 39%, but 39% of metropolitan areas are going to experience price declines. And not only is that the case, we can also see the nerves getting to the home sellers. According to Realtor.com, 1 in 5 sellers in August dropped their asking price. A year ago, that share was just 11%. But note that this could just mean the sellers just have a super crazy expectation these days. Trust me, I know, I work in the industry. And so why is this happening, and how can we prepare for the future? Well, in order to get some clarity, you need to understand one of the most key economic data, and that is federal funds rate. The term federal funds rate refers to the target interest rate set by the Federal Open Market Committee, FOMC. This target is rate at which commercial banks borrow and lend their excess reserve to each other overnight. The FOMC, which is the policy-making body of the Federal Reserve System, meets 8 times a year to set the federal funds rate, which is part of the monetary policy. This single number that they set has the power to impact your home loan rates, how much things cost in the shops, and the rise and fall of GDP, stock prices, and even cryptocurrencies. Now, increasing the federal funds rate has been expected as we have seen some crazy inflation in the recent months. And the way this controls inflation is by reducing the capacity to borrow for people to go and buy homes and businesses to take on new projects. The demand for goods and services will drop across the board, reducing the price of everyday items. And here the Feds have openly admitted that while higher interest rates, slower growth, and softer labor market conditions will bring down the inflation, they will also bring some pain to households and businesses. And the Fed rates, yes, they are expected to rise in the near term. However, the markets are pricing in the peak rate of 3.4% by February 2023. And of course, the subsequent drop in the fund rate would have implications on housing and stock prices across the board. Right now, the federal fund rate is at its highest since 2007. And with more climbs in the horizon and the buyers' distaste in higher mortgage rates, the housing market is expected to fall further. So how will this play out, and what does this mean for you? So right now, the sellers can't get the price that they wanted for their properties that are for sale right now. So they are instead choosing to rent out their properties. Now, this is required as the rents have been way too overheated, with crippling shortages in rental supply across the board, with national median rent hitting a new high record of $1,879 a month in July, up 12.3% from a year ago, according to Realtor.com. Overall, whilst there are very real concerns that housing will continue to be hit by mortgage rates now well above 6%, however, the average home equity levels are high, and whilst this puts a lot of people who bought in 2021 and 2022 in danger, a housing crisis is very unlikely. A more likely correction would come in around the tune of 5 to 10% dip on the national average, and this is probably for the following reasons. Supply is still remaining crazy low across the board compared to previous years. The recent increase has made the price react with a double whammy from higher mortgage rates, but this seems a little temporary. And by this time, you all know that a strong majority of the properties remain in positive equity, and a forced foreclosure is unlikely to increase the supply in the market. So overall, it is unlikely that a housing bubble pop of the 2008 would repeat in 2022, 2023. So what can you do to make some money or not lose money in this market? If you're a seller in the market right now and you need the money, try to sell. You're still sitting very pretty compared to the few years ago. And if you bought property in 2021 and 2022, you would be quite nervous, as a 10% drop would likely put you in negative equity. If I were you, I'd be looking at locking in a high rental rate with the heat of the rental market right now, and try to ride out the next year with the advantage of higher rental returns. Now, this is possible as residential leases are usually 12 months and the rents are actually fixed from the beginning of that term. Now, if you're a buyer right now, try to shop around as there is increased inventory. Have the courage to walk away from deals that don't fully satisfy your standards, and even wait and see how the market will be in the next couple of quarters or so. And of course, if you like this type of super informative and helpful video, then be sure to smash the thumbs up button, like, share, and subscribe, and make sure you have the notification turned on to catch the next episode.